Hello, everyone. Welcome again to another episode of How to series. Today, we're going to talk about how to be investment ready. And as we all know, funding is critical to any startup in any stage. And of course, there are no magic rules, no magic formula, but probably there are a few things everyone should know, at least to avoid some pitfalls. To help us understand a bit more about these, I'll be chatting in this next hour with Filipe Portela from Till Impact, who is a very knowledgeable person in this field. And so, Filipe, first of all, hola, welcome. Thank you for taking your time to be with us. Very generous of you. And before asking you to introduce yourself, or we can start by that, but I would like to kickstart this with a very simple question that is it true that money is so abundant that investors are just crazy dying to distribute it as fast as they can?
Hi, Pedro, and thanks for the invite, and to Canopy also. Pleasure to be here. Always a pleasure to discuss about these topics. Just jumping into your question, I would say it is half true. So, sorry. So there is definitely not a lack of cash, not lack of money on the investor side, but that doesn't mean that they are actually just crazy just to invest in the first company that they see. Especially now. Now we are in a buyer's market. So what that means is that the power, in some sense, it's on the investor side. And it's true that there was never so much dry powder, so never so much money in the investor's pocket as there is right now. But again, it is a buyer's market, so they are being really careful on where and to whom they invest in at the moment. Everyone is saying that next year is going to be a recession year. Let's see what happens. But so it's true that there is a lot of money, but they are not just crazy investing in everything they see. So hence, this talk is so important because it's really important for the entrepreneurs and for the companies to be ready and to know who to talk and how to talk with the potential investors.
Awesome. And for those who don't know yet, who is Filipe Portela and why does he understand a bit about this? A bit, by the way, a lot about this.
I'd say a bit. If you don't mind, I'll jump right into my presentation because I have a small part on that also. So let me just do that really quick. Okay, just share screen. Okay, let's do it. Sorry. So here we are, and let's jump into it. Just putting this all together. So hello, and like Pedro said, I'm Filipe Portela. Just to talk a little bit about myself. So I'm in the entrepreneurial year field for the last 20 years, something like that. I had my fair share of successes and failures, of course. I'll probably just talk about my successes. No one likes to talk a lot about the failures also. But yeah, I was one of the founders of Healthy Systems, a digital health tech company in Porto, actually. This was back in 2012. I'm also the founder of Impact Hub Lisbon, which is a global space ecosystem that has something like 100 spaces across the globe, and just a melting pot, just places where social entrepreneurs and impact investors, they just meet and they talk, and of course, make deals and make magic happens. I didn't see this, but I was lucky enough to be one of the first employees there back in 2016. It was a crazy ride. And now with a new logo, because it was just bought by Republic, which is an American company. And Republic is now the owner of the American and the European business. Good times. I also worked some time for the European Innovation Council, which is basically the platform responsible for bringing private investors to the public invested companies. Great initiative, really interesting. And like Pedro said, I'm a partner at Till Impact, pre-seed and seed investment fund that started 2 years ago. based in Portugal, but we invest across Europe. We are not a very active investor, so we invest about 2 investments per year, maybe 3 sometimes, but we are very hands-on. So low number of investments, but the ones we invest in, we are very active on those. And more recently, I'm just helping a couple of friends launching their product studio, which is something that is in real need for a lot of companies. Really hard to hire developers, really hard to hire these designers. So basically what they are offering is just a solution in the box. So if you want a product, they will build it for you. And now, since we take care of that, let's jump right into it. And since we are talking about investment, right, and investment advices and fundraising and all of that, I do usually start with a very simple advice and very straightforward, which is basically don't do it. So that is my first advice, is don't go for external money. Don't go for external money unless you actually really need it. And you are in the right spot, in the right moment to actually go for that external money. It is very time consuming. It is very energy consuming. So if you can avoid it, don't do it for sure. Yeah, I know that the news and the media, it's heavily on that, heavily on external fundraising, but there are a lot of good companies, very successful companies that never raised a cent outside, and they were always organic, growing organically. So that's possible. That's a way. So again, just to reinforce, don't do it unless you actually really need to do it. Also because you have other ways of actually getting money in your company, of course, sales. But if you can do that, pre-sales, or also known sometimes as crowdfunding, either it is reward or equity based. But crowdfunding is not more than just doing a pre-sales campaign, especially if you have a product, something physical, something tangible. If you don't have that, okay, you can do an equity one. It's feasible also. Again, Seeders, Republic, there are other, of course, but accelerator programs, awards, grants, eventually debt. I'm not a big fan of debt, but of course, if you are in the right stage, if you are already with some cash flow in your business, debt can be a solution. So what I'm trying to show here, what I'm trying to share is, okay, fundraising external money is not always the solution. There are other solutions, and only go for external money, only go for fundraising. Again, if you are in the right moment, in the right spot. Okay. And now you might ask, okay, what is that? What is that right moment? What is that right spot? So yeah, so let's dig a bit into that. I really like this chart. So let's look at the company life cycle. Any company, I would say, either small, big, product, service, whatever it is. Usually, let's divide this into development or time, so on the x-axis, and then revenue or growth on the y-axis. And every company, whatever it is, they always have an S-curve, okay? So they start by losing money, usually. That's what happens. And then they will start growing. So losing money, then they will start growing the revenues and something. Eventually, they will build a product that is really successful, and they will jump, they will scale in some sense, right? And then eventually, competition will catch up, markets will change, whatever it is, and the company or that product itself will plateau and eventually mature, you know? And then everything starts again if you have another product or another company or whatever it is. But again, either it is 5 years, 50 years, whatever it is, all companies, they have this S-curve, okay? And if we plot into this, the different stages of any company, so the early stage, so the pre-seed and seed, so again, losing money, pre-seed, just funding out the product market fit, all of that. So here, growth, you already found something successful, a product or a service, you are scaling, you are growing. Okay, really, really nice. And then eventually you will reach your maturity phase, right? And what I'm trying to say here, again, different phases, different needs, because in each stage you will have different potential investors. Okay, so first of all, when you are losing money, you will have the so-called 4Fs, sorry. So family, friends, and fools, right? And founders. I always hear about the 3Fs, but I always prefer to talk about the 4Fs, because founders, they are for sure the first ones that put the money and the blood in the company. So let's not forget about them, okay?
Yeah, a lot of skin in the game before bringing in the other Fs.
Definitely. Those are definitely the first ones. So I always prefer to talk about the 4Fs. And here you usually also, again, if you have a product based, something tangible, a reward-based crowdfunding can be a solution for sure. Again, pre-sales. So you can actually be selling your product even before you have it, sometimes like 12 months, even before you have something. And it works. So we are not talking about a lot of money. We might be talking maximum 10 to 20K, not much more than that, usually, okay? There are some outliers, but usually 5, 10, 20 maximum. So don't expect much more than that on the reward-based crowdfunding, okay? And then eventually, as you mature, as you build your MVP, your proof of concept, as you actually get 1 or 2 customers, something like that, you might be starting to get interesting for business angels, of course, usually the first investors. Equity crowdfunding also starts to be a solution. So the big difference between equity crowdfunding and reward-based is here is you are doing a pre-sales of your product. With equity, you are selling a piece of your company, basically. So that's a big difference. Also, in reward-based crowdfunding, again, 10 to 20K. In equity crowdfunding, usually the minimum is 50K. And it's not crazy to aim for something like 200, 300, or even 500,000, okay? It's doable. Not as easy, but completely doable. But again, you need to be on a different stage. And again, eventually, as you develop, as you grow, as you get into a more scalable phase, venture capital for sure. So more money, more responsibilities for sure. Again, if you have some cash flow, debt can be a solution, either banks or peer-to-peer. So solutions like GoParity or Mintos or whatever, peer-to-peer solutions, they are there. There might be a solution if you have cash flow. And eventually, when you get to a more mature stage, you might do an IPO. So you might go to the stock market, or even being bought by a private equity, doing an exit, or SPAC, if that happens. So what I'm trying to say is, again, if you are in an early stage, usually you don't talk to a VC. It's definitely you don't talk to a private equity. And again, if you are in a growth stage, you are not going to talk, probably not going to do a reward base, or not going to talk to a business angel, because your funding needs are much more than the business angels can do, right? So different phases, different needs, talk to the right investors. That's what I'm trying to say here, yeah, so basically.
One could summarize like initial money is to start building something, start building a team, start building an idea, start building an opportunity. Then we are actually building the thing, and you need more money to ensure that we can do something that is actually a business that could grow. And then we go into the third stage, which is actually growing, and you need a lot of speed, meaning a lot of money, and or a bigger amount of money, not a lot of money. And then you reach Valhalla, and you're going to become, the very successful entrepreneur, launching your IPO or whatever, something like this.
Mm-hmm. Let me just, I agree with that. Let me just do a small correction on that, which is, so in the initial money, I wouldn't put the focus on the team, although the team is definitely important for sure. Sorry. But what the first funding you are looking for is to build the product, okay? And that's where the focus should be. Of course, you need the people, but no investor wants to put money in the company to pay for human resources or to pay for salaries, right? So they put investment, they put money in the company for the product, for you to
Right.
build the product, and that's what you are doing in the sense, in the end, that's what you are doing. You are testing out, you are finding the product market fit, and then it is exactly as you said. So you are experimenting, you are building something new, trying this product market fit, then you find something, then you need to scale this, then you need to prove, okay, is this right? And then eventually, okay, it's working. Let's put a lot of fuel on this motor. We need to grow. We need to grow fast. And again, probably need a lot of cash to do that, to catch the market before the competition does something like that. And yes, so that might be the roadmap for sure. But I prefer to put the focus on the product itself and not so much on the team. Although, again, team is definitely a very important aspect of every company.
Thanks for clarifying, because there was a bit of a provocation, because the underlying message is not expect to be paid by initial investors. It's up to you to take care of your own living.
Yeah.
And don't expect to bring in very expert members to your team. You can do it, but you have to do it via sharing part of the company or whatever means of negotiation that you can create and actually manage to implement with them. Money for people will come later.
For sure. And usually this is something, and I'm glad you touched that point, because it's something it's not talked about enough, in my opinion. But usually the founders, and in some sense the team, they only start to get paid decently, I would say, probably after a Series A, sometimes even after a Series B, Up until then, so pre-seed and seed, usually it's just survival money, it's just survival salary. Only when the company reaches the product market fit and it starts to scale, that's when salaries start to become decent. Let's put it that way. So only about pre-Series A, Series A, something around that. Not before that. Before that, it's just survival money. So that's something that entrepreneurs need to be aware of also. That the first couple of years, they are rough. It is a lot of hours. It is a lot of work. And not enough pay. It's always working for the potential in that sense, right?
They could find a better job if they wanted.
for sure. No, for sure. Especially on those initial years, a better paying job, for sure, definitely. Then, but again, they are working for themselves. They are building their dream, and eventually, if it works out, they will be better off, for sure, working for themselves. But if, and that is a big if, of course.
Yes, it's pretty much investment. And,
it is
a long journey, and really help them, by the way.
So moving on to the investors now. So we are talking about the company, different phases, different needs, and all that. So let's talk about investors, right? What are they looking for? How can we approach them? All of that. And there is a simple truth that is, the first one is always the hardest one, okay? Getting the first investment, getting the first yes, that's all, even if it is a small amount, but that's the one that is actually going to make it happen. So whenever you talk to a second or third investor and you share that, I have the first believer in that sense, everything starts to be smoother, everything starts to be better. So what I'm trying to say here is put a lot of effort on your first investor, try to get that first investor, and also don't forget that the first investor is the one that is going to set the terms for everyone else. So although you need to put a lot of effort, you cannot also give everything to that first investor, otherwise you'll be giving everything to everyone else.
Yes, and if I may, just another thing, I think sometimes it's underrated, is the need to have a great, I would say, screening of the first investor, because it sets a lot of things. It's not irrelevant to who that company or person is for the coming investors. So having the right first investor is not just about the money, and of course, they're not just about the value that he or she or the hit can have actually add to your business. It's also don't forget, it's also like the labeling your company and your idea. Because of that connection, the endorsement can be either positive or negative, depending on where you plan to go ahead, right? And it's not that I'm saying there are good and bad investors. That's not it. I'm just trying to say that not all investors are the optimal choice to be the first one. Maybe they are great to be on the later round, not just the first one.
No, you are totally right. I totally agree with you. Yeah, and it's not bad or better investors. It's just better fit, basically, and that is very true. So the first investors are definitely the most important ones, again, because they will be setting the terms, and they'll be setting everything else for the next comers, basically. And for instance, if you have a couple of investors, 3-4 investors, for instance, the last one can be much more just about money, for instance. Even if they don't bring a lot of value to the table, and they just bring value. If you have that value from the first investors, you can do that. So I totally agree with you. The first or the first ones investors that definitely are the most important to set the tone for everyone else, basically.
Great.
So yeah. So what are they looking for, actually? So we're talking with the investors. They are looking at our deck and making a decision and all of that. And what are they looking for? Again, team. Team is usually, and if you talk to the majority of investors, they will say one of these three. And what I see most is definitely team. So what they like to see in team, they don't like solo entrepreneurs. Although it's a thing that is growing, but usually it is a risk, because if something happens to that person, the business goes down. So that is a huge risk. So usually the right fit is something between 2, 3, 4 maximum founders. More than that starts to be a lot of mess also. It's too confusing. So 2 to 4 people, of course, that have complementary skills, okay? They don't need to know everything about the business, because usually they don't. But it's really important that they are aware of the things they don't know, okay? So for instance, let's say that they are building deep tech, whatever, fiber optics, and they understand something about that, but they need a new scientist or something on just really specific on that. It is really important that they are aware of that, and that they share this with the investor. And for instance, oh, listen, we actually need investment because part of this is going to be used to hire this specific person to improve our product, for instance. But again, we are talking about a person, but always focus on the product. So this person is going to do this on the product. We want to build the product. We want to improve the product. That's what the investor wants to see.
Yeah, it's like looking into the critical path of the product development implies bringing in that person. It's not that we want that person. It's that we need it. Yeah. We need that person. We need that hiring to ensure that we keep on track to develop.
Exactly.
And that we are not lost. We know we need it.
Exactly. Yeah, we know. So we know what our powers are, and we know what our powers are not also. So when we need to complement our skills here, there, and there, and that is really, really important. Also, market, of course. So the size of the market. Is the market growing? Is the market shrinking? Is the market concentrated? Is it fragmented? Is it a low barrier, high barrier? How is it? Of course, that is really important. And of course, again, product. And if there is or if there is not a product market fit, of course. So what are you building? Does this make sense? Are actually people interested in this? Is there a market for this? Are you the right persons to build this? Do you know what
can you
need
deliver?
To build this?
Can you deliver?
Exactly. So this is usually how investors make their decision. So what the main things they look at and how they invest. But the curious thing is that they actually invest in different things, okay? So they like to invest in different things. So usually what they like to see is also some technology, of course, or IP, if there is. So they like to see something that is unique, something that's not easy to be replicated, of course, okay, because that's where they are putting their money in. They like to see some assets, if there is. So nowadays starts to be more difficult because everything is digital, so not a lot of assets there. And of course, if there is some cash flow. So usually that's what every investor loves, especially if you are in a more late stage or in a more mature stage, cash flow for sure. If you are more in the pre-seed stage, in the early stage, you don't have any, you are just selling potential, basically. Okay. Yeah, exactly. It's just cash burn. So what I'm trying to say is, okay, show everything that is on the left. So this is what they like to see, and then show potential for this if you don't have. But basically what you should do is you should show how you are going to transform this into this, basically.
All right.
That's what investors want to see. And of course, since we are talking about investors, it's not a one-way street. So investors, they ask a lot of questions to the entrepreneurs, to the founders, and like you mentioned, it is really important for the founders to do a screening of the investors also. And the founders, they should accept or not accept the investors, of course. So here are some questions I always recommend to ask to the investor or to do a pre-screening before talking to investment. And usually that's sector, of course. So am I deep tech? Am I going to talk with an investor that only does marketplaces, for instance? Probably not. Probably doesn't make sense. Or the other way around, for instance.
Yeah,
okay.
Sure.
Or I am a service. I'm a service, and am I going to talk with an investor that only does product, something like that? Or I am a blockchain. Am I going to talk with an investor that doesn't understand anything about blockchain or metaverse or Web3 or something like that? So what I'm trying to say is do the screening and talk to investors that understand what you are building and understand your sector, of course. Really important and nowadays, not so much, but usually always really important is the so-called dry powder. So does the investor have the money to invest in you? Especially if you are in a more mature stage or when you reach a more mature stage. This is really important because one thing that I see a lot, although I don't agree with it, also to be honest, but investors, they are always fundraising themselves. So usually VCs, mainly VCs, not business angels, not so much, but VCs, what they do is they go to more institutional investors, bigger investors, they pick up a slice of their money and they pick up that money and they invest in companies, basically in startups. But themselves, the VCs, they are always fundraising also. So sometimes what happens is they are actually talking to companies and they are building a pipeline, but they don't have the money yet to invest in those companies, okay? So what happens is they build a pipeline and the company stays there. And they sometimes even say, oh, yes, we invest in you, we like you. And then the company stays there waiting on hold until the investor actually gets the money. So it's really important for the founders to ask this and to ask to the investors if they actually have the money. And if they don't, when do they expect to have the money? Okay. It's really important for this transparency. And I know that investors sometimes, not all investors, they are actually really transparent on that front. Okay. Number of deals, of course. I like this because it shows how professional the investor is. Of course, it's just a number, but sometimes it helps to get an idea if the investor knows what they are doing or not. And of course, which is really important, ticket size. So if I'm looking for 1 million. I'm probably not going to talk to an investor that only does 50K, for instance, or even 100K. Probably that's too small.
Or the other way around.
The other way around. Exactly. So if I'm looking for 100K, I'm definitely not going to talk to an investor that only does 2 million. And that happens a lot. Again, different phases, different needs. An investor that only does 2 million, 5, 10 million, they are looking for more mature companies. Bigger companies, they're not going to do an early stage. So if you're looking for 100K, go for a business angel, maybe a smaller VC, something like that. It doesn't make sense to talk to other bigger investors. for sure. Okay. And also IUM, which is your assets under management. It's always important, again, alongside deals, just to get how professional the investors are. It's just a number, but it can help to put a picture on how the investor is. Okay. And so the investment itself, and like you said, this is a marriage, basically. So again, the founders need to be really careful and need to, they are building a relationship. So you don't do a relationship with just anybody, right? So again, you need to be careful with who you bring to your company and with whom you are building a relationship. So this investor should be someone that you are comfortable with taking some drinks, of course. But most important is you also need to be confident or comfortable about discussing hard topics, okay? So telling bad news, okay? And this is really important because building a company, it's not always roses, right? It's not only beautiful days. There are really tough days, really bad moments. So you need someone that actually can be there and that can support you on these tougher moments, okay?
This is not like marrying in Las Vegas after a one night stand.
Exactly. Usually that never ends well. So again, do your screening, talk to your investors, all that. So this is like a marriage. This is a relationship, and if it is a good one, it's going to last for a lot of years. So try to make sure it is a good one for sure. Okay?
If I may add, don't lie, don't hide.
No. That's the worst thing you can do. Be completely transparent, completely honest. If that scares the investor away, great. It wasn't the right investor for you. Yeah, but don't try to hide anything. It's just going to ruin everything because sooner or later that will come up and it will blow up in your face, basically. So yeah, just don't do it. Another thing I would like to highlight. So we are talking here again about fundraising, money, equity usually, but let's not forget that we can always do a mix of different capitals, right? We can do a mix of equity and debt. We can put some grants in the middle. We can put the three of them. Again, it really depends on where we are operating, but we don't need to do everything on equity. We can put just a little bit of debt and equity on top. For instance, if we don't want to give up a lot of equity in the beginning, usually my rule of thumb is don't give away more than 20% per round, okay? So if you need more capital and you don't want to give away more than 20%, try something else, try grant and equity, debt and equity, something like that, okay? Just to put it out there that there are other solutions than just selling equity, okay?
Yeah, maybe keep your eyes on the valuation, because sometimes I think we all seen people reaching to the moment where they need the money because the runway is short, but they still haven't the proper valuation. And so there's a huge imbalance which harms either equity or the ability to the company to keep alive or developing on the fast pace they wanted to, because the 20% with the acceptable valuation is not enough for them.
Yeah, and, but when you are running out of money, that's always a bad moment to raise capital. You should think a year ahead of that usually. And now in this moment, probably 18 to 24 months ahead of that, because how things are and how investors are, they are just keeping the money in the pocket.
Do it before you need it.
Oh, definitely. It is the worst time to go after money when you need it. So that's you are basically putting all the power on the investor side, and you are not going to do a good business for you for sure. Okay, so let's talk about funding needs. I think this is always a question that always appears. Is usually companies they are not sure how much money they need. My recommendation is easy. It's just capex and opex, and that's it. So what is this? So basically, is the money you need to buy any material or any equipment, and that's capex basically. So I need to buy a car, or I need to buy a machine, or whatever it is. So that is that amount, 50K, 100K, whatever it is, plus OPEX, so plus operational expenses. And usually the recommendation is 12 to 18 months. Again, as the market is right now, I would suggest something more like 18 to 24 months of operational expenses. So if you need, let's say, 50K for equipment, for license or whatever it is, and you need 150K more for 24 months of operations, so in total you need 200K, and that's how much money you need. That's how much you need to raise. If you want to put how to usually say it in Portuguese, the caganço factor, you can put something, a premium of 20%, for instance, so 240. Okay.
Just in case.
Just in case. Inflation and all of that. Okay. So by your math, you need 200. Let's put it 240. Okay. So and that is how much you need to raise.
Which means your company should have a valuation of at least 1 million.
At least 1 billion. Exactly. Yeah, exactly. And we are exactly going to talk about that, because like you were saying, the investment round is always a mix of these three things, right? So your company valuation, how much equity you are going to raise, and how much money you are going to get away, you're going to get from the investor, right? And like I said, 20% max per round. This is it. So if you need 20K and you are 200K, and you are going to give 20% maximum, your valuation is 1 million. That's it. Simple. Post money, of course. Pre-money is before the investment, so it's 800K. With investment, 200K, it's 1 million post money. Okay. But again, if you just give away just 15%, if you are able to do that, what you are saying is for the same 200K is that your valuation is 1.3. Okay. So I'm just putting this out here just to show how these things change really quickly, just by changing just the amount you need, or just your valuation, or just the equity. Because on the other way, if you don't change the equity, if you change the value you need, if you need 400K and not 20, your valuation is then double. But of course, you then need to justify this, because, okay, it's not just as simple as getting to an investor. Oh, I think my company is valued at 2 million. Okay, but why?
Yeah.
Why is
Can you demonstrate that?
Your competitors, yeah, exactly. Your competitors, they are worth 1 million. Why am I going to pay 2 million for your company? You know, so this is something that, of course, founders need to justify, of course. But this is just put it out there. This is something, of course, that founders need to do beforehand, before starting talking to investors. They need to do this math. They need to think really well how much money they actually need, how much equity are they comfortable in giving away. Again, maximum 20%. 25 is already a bit over, but if it is the first, or if you actually you're about to close an investor you really like and you think is going to be really valuable for the company, maybe 25, but not more than that, please. And again, of course, you need to justify that.
Maybe it's fair to say for the less experienced founders that are listening to us, that this 20% is not just because, it's because there are several rounds. And if you start giving a lot of equity from day one, you end up too soon to have a so small share of the company. It's not that you lose control of the company. That's not the thing. The thing is that you lose the only thing you have to sell, actually, to trade for the money, which is equity. So if you give 30% instead of 20%, after 3 rounds, you reduce to 10%. If you start with 20, you hold more rounds. That's just it, don't you think?
Yeah, you are gone. You are completely right, and thank you for that, Pedro. It is exactly that, because we are expecting that you are a type of business that you're going to need to do a multi-round. So you're going to do multiple investment rounds. And it is exactly that. It is expected that when they reach a that the founders, so the founding team, still has 50 to 60% of the company, but at the bare minimum, 50% of the company. So usually if the founding team has less than 50%, that will scare off the bigger investors you will need for the series B and C and so forth. Because what happens is, so no investor or no good investor, let's put it that way, they don't want to buy the company at this stage. So they just want a slice of the company. They just want a piece of the profit and of the potential future profit, of course. But no investor is going to be working for the company. So what they want is for the founding team to be the ones pushing the company and to be the ones working for the company. And of course, if the founding team, if they don't have enough equity, they won't be doing that. Of course, they don't want to be working for the investors, right? They want to be working for themselves. And the smart investors, they want that also. They want the founding team working for themselves, because if they are successful, the investors are going to be successful. So again, so these are usually the rule of thumb. It's 20% per round, and you are going to do 2 rounds, maybe 3. And of course, if you give more in the first round, then you need to give less in the other rounds. If you give less in the first ones, you have more margin in the next ones. But when you are going to do your Series A, you are expected to have at least 50%. And again, it's not 50% for the founder, it's for the founding team. So if it's 2 people or 3 people together, they should have at least 50% or more than that. Okay. So that's why we are saying 20% maximum.
Yeah. For the sake of time management, we are now up to the last 18 minutes. Okay, and as I suspect, this program should have, this episode should have like at least a 3-hour duration.
We are just touching the tip of the iceberg. This is just touching.
Okay, just share this.
Just browsing. Yeah,
exactly. Just share this time management thingy, because I think it's.
Yeah, I think we are on time for sure.
Yes.
And so just talking about some metrics about the valuation, or how to justify the valuation. Okay, and here it's not written, but it's divided into. So if you are revenue on the left and pre-revenue on the right, something like that. Okay, so let's talk about early stage of pre-revenue. So you don't have revenue, but what you can show is, for instance, downloads. You can show that, or signups, pre-registers, or monthly unique visitors, even if they are not paying, pre-sales, something like that. So what investors like to see, if you are pre-revenue, they like to see some traction. So they like to see something happening. They like to see that, okay, actually the users, they want this, or it seems that they want this. Okay, that's what you need to show to the potential investors, of course. If you are revenue, if you already start to have revenue, so they start to want to see something which is monthly recurring revenue, so your cost of acquisition of your customer and versus the lifetime value. And of course, they want to see here a nice multiple, or at least going that way. If you are still in that phase that you are still building and you are entering the market, and still it's not bad if you have a higher CAC than lifetime value, but you need to show that your CAC is lowering and your lifetime value is growing, basically. And of course, your burn rate. So where are you spending your money? Profit margins, gross and net, and all of these, basically. So if you have revenues or no revenues, but the thing is, you can always show, and you should always show to your potential investors what is the potential of your business, and what is happening. What can you make it happen here, basically. But again, even if you don't have revenues, you can show the potential of that. And these are just some examples. Okay. Another question I always see a lot is about business plan. You should do one for sure, but you should do one for yourself, basically. If you have an investor that actually asks for your business plan, run away. Because from my experience, no investor is actually going to look at your business plan. What you need to share with an investor is a pitch deck, for sure, which is a 6 to 12 slide visual slides showing what you are building, what you want to do, all of that, and some financial for projections. So an Excel with your financial projections, for sure, with your financial model. But no investor is going to ask for a 30-page business model. They're not going to look at it. They're not going to read it. They don't have time for that, to be honest. And if they have time for that, I would say it's probably not the right investor for you, unless you are just picking that person that it is a business angel, that it doesn't do investments, and you really want him in your company. Otherwise, a professional investor, they don't have time to be reading out 30-page business plans. But do it for yourself. Yes, Pedro.
But would it be correct to say that will increase on later stages, meaning later when I've passed the early stages, it will be more common to see them more interested in doing due diligence and the like, not on the first meeting, of course, after they express their interest?
Don't get me wrong, due diligence, it always happens. Either you are in early or late stage, for sure. Legal, financial, it always happens. What I'm trying to say is that, so the information the investor usually wants, it's not in a 30-page business plan. That's it. What I'm trying to say is you should do it as a founder. You should do it because you should know your business front and back. That's it. But basically, what the investor wants is, again, 6 to 12 pages of that, which is your executive summary, which is your market analysis, which is your organization, of course, which is your product and service, and that's it, and your financials. Okay, and usually something like what is your unique value proposition, your business model. It's stuff like that, and this each one can be a slide. That's it.
Thanks for clarifying, because I think unless you are experienced, I think we've all seen incredible worksheets piled with information. People spend a lot of time, and the problem is not they are sharing that with someone. The problem is that they built it to try to impress someone, but they don't actually use it for running the business. Yeah. And that's what I was trying to provoke in this conversation with you. This question is, build something that is useful to you, and don't waste a lot of time in things that investors do not care about. They don't want to be overwhelmed.
Exactly. No, you're totally right. It's build it for you. Definitely, you will need it. You will need it to run your business. And whenever the investor asks for it, you just go there and pick that information, that specific information, and here it is, one slide. That's it. And always try to put one slide. Don't do a 10-page thing just to write your business model, for instance. It's crazy. No one is going to read that. If someone asks, if someone asks your business model, exactly. If someone asks your business model, here it is, one page. If someone asks your financial model, here it is, an Excel. That's it. Someone asks, what is your market analysis? Here it is, one slide. One page. That's it. And the more visual, the better. And again, I'm saying this, it's not easy to do this. It needs some practice, of course. But like you said, if you are able to do this, it really shows that you understand what you are talking about. If you are able to simplify this into one slide and a visual slide, amazing. It shows that you know what you're talking about, for sure. And of course, we need to value the company. So we already discussed a bit about that earlier. And let's just dig a little bit on that, because we might have some traction all of that, and I want to justify my 2 million valuation for my company. Of course, comparables, it's usually one of the most used. Of course, it's the similar companies in similar regions, they are doing this, but please, again, I'm always saying this, don't compare apples to peers. So don't compare a Portuguese company, so south of Europe, with an American company, completely different markets. So don't compare Europe to the States, and don't compare north of Europe with south of Europe. Okay, I know it's not fair, but it is what it is. A South European company is worth less than a North European company, and a European, either South or North European company, is worth less than an American company. Okay, it is what it is. American investors, they are able, or they are willing to pay much more for the risk. They are much more risk takers than the European investors are. Okay, so it is the market. If you want higher valuations, go and open a company in the States, or go and open a company in north of Europe. That's what they did. That's what the Portuguese unicorns did most, except for one. Sorry, Pedro.
But I was just adding, about to add that that's not a magical rule. Don't think your problems end on the day you open your company in the United States, because it's not just moving the address and the fiscal number. It's entering a different market with different rules, with different legislation, with different culture, with different everything. So don't think it's that easy. Just open the company there and boom, you're rich. By the way, there's also more competition for money there.
Oh, of course, definitely. But let's talk about something. Some things that can actually put your valuation up. Okay. So we're talking to an investor, and some stuff that can push your valuation up. So if you are in a hot sector, okay, like blockchain was, Web3 was a year ago, not so much at the moment, but now more health is still a hot sector, I would say. Biotech, sure. Everything AI at the moment, whatever that is, AI, everything, machine learning, everything is definitely a hot sector. If the management team, the founding team, is definitely a good founding team, if they are serial entrepreneurs, if they had already 2 or 3 exits in the past, all of that, of course, that will push the valuation up, definitely.
Filipe, sorry. Due to the current circumstances of war in Europe, what do you think that energy and manufacturing can become a hot sector?
That is a pretty good question. So manufacturing, it's maybe, but it's not an easy sector, because there are not a lot of investors actually willing to invest in on that. Okay. So everything that is hardware based is always going to be a harder sector, because the number of investors goes down drastically, basically.
So the bigger the capex needs, the biggest the nightmare to get the money. Something like this.
Exactly. And I was going to say exactly the same thing for the energy. Energy is definitely a hot sector, especially if you are working on low capex or more digital energy stuff. So if you go for infrastructure, if you go for batteries, if you go for networks, whatever it is, if not digital networks, if it is physical networks, it's always a little bit difficult, because the number of potential investors goes down drastically. So where you have the most investors is everything that is tech-driven, tech-enabled, digital side, software, basically. Everything that is hardware-based starts to, for instance, health tech. If it is digital tech, yeah, lots of investors. If it is actually physical hardwares, physical medicine
devices, whatever,
medical equipment, yeah, exactly, devices. Yeah. The number of investors goes down drastically. They are there, of course. They're out there. Yeah. They are way less.
It shrinks.
Okay. But energy is definitely a hot sector at the moment, and anything alternative energy, save energy, all of that is definitely a hot sector for sure.
Okay, 6 minutes to end, and I'm already feeling sorry.
No. I think we are getting there. So say functioning products, so traction and all of that, product market fit, of course, you can push your valuation up than the other way around. And of course, what can put your valuation down is, of course, in a sector that shows poor performance, or sector where companies are closing down, or there are no margins. The investor already did that experiments in the past. and they weren't so successful. If there are a lot of competitors, if there is a low barrier market, all of that, of course, if it is the first company that the founding team is actually doing, it's not an handicap, I would say, but the thing is that is not going to push you up, of course, like if it is the second or the third or something like that. And of course, if you are pre-revenue or you still don't have a product market fit and all of that, all of those things are going to push you down, of course. And of course, like we were talking, if you are going out of cash, yeah, it's definitely not going to be benefit for you, definitely. And like we were talking about, it's always important to look at similar deals in the same region. Okay, if it is different region, you always need to put a discount factor on that. Of course, how are the past exits in those sectors in that market? Are they good? Are they bad? What's happening? For instance, the recent Figma sale to Adobe, where they were valued at 20 times their sales, that was definitely good for SaaS. So SaaS, everything SaaS is definitely interesting at the moment. Okay, so this kind of events is always important to be aware of. Either they are good or they are bad, because depending on where you are working. Of course, what is happening to the market, to the industry, and of course, if you have any financial performance in the past, or of course what you are expecting in the future. Don't forget that investors, they put 10 and they always want 100 back. So usually they want 10 times what they invested back. So always keep that in mind. Okay. Just to finalize, 2 more ideas. So if you are talking to investors, we are going to present the pitch deck. Of course, we are going to talk with them. So bear in mind that your pitch deck, again, short, visual, 6 to 12 pages maximum. That's what you send to your investor the first time you want to talk with him. Bear in mind that the pitch deck, the idea for the pitch deck, it's not to close the investment, is to get the meeting. Okay, that's what you want. So you should get investor interested enough that he wants to talk with you. So you don't expect for the pitch deck to sell you the company. So don't expect to close the deal with your pitch deck. Okay. And of course, minimum slides possible, either on the pitch deck and on the meeting itself. Always 1 idea per slide, please. Okay. Keep it short, keep it simple, to the point. Okay. If possible, always be a mix of rational and emotion. Okay. Of course, more rational, I would say, but also a little bit of emotional. It always works, of course. Don't read from your slides. You're already lost. And I really like the 10, 20, 30 rule, which is basically 10 slides, 20 as the minimum size of the lettering. So if you are writing anything, 20 is the minimum size you should be writing.
The font size. Guys,
the
listen
font
to
size,
this, 20.
Thanks.
Don't use 12.
No. That's you are dead. Don't write at all if you can. Just put graphs or visuals. Don't write. If you need to write, 20 is the minimum, please. And always aim for a 30-minute meeting. So even if you have 1 hour, something like that, aim for a 30-minute meeting, where usually 10 minutes is for the pitch, 20 minutes. If it goes longer than that, great, you got their attention. If it doesn't go long, it doesn't mean anything. But always aim for that. So what I'm trying to say is be concise, be to the point, and that's it. And you will get there. My very last topic or idea I would like to share is that in the end, this is also a probabilities game. Okay, this is also a numbers game. Okay, so for instance, if you want to close 4 investors, let's say, I would say that you will probably need to cold call or cold email or cold outreach to about 400. Okay. So because from those 400, you will probably going to get 30 to 40 meetings. Okay. And from those 30 to 40 meetings, you will probably going to get 3 to 4 investors. Okay. Just to give you an idea of the size of the numbers. So don't talk to 10 investors and expect to get 3 yeses. Okay? So the most common word you are going to get is a no, and that's part. But eventually you also get yes. So what I'm trying to say is you need to do a lot of pre-work. You need to understand with whom you are going to talk, how you are going to talk with them, how you are going to reach, and what you are going to actually be selling them, because different investors, again, they are buying different things. And then again, you need to talk to a lot of investors to eventually get the yeses you want to get. Okay.
Okay.
And
so,
yeah.
And if you don't mind, stop sharing.
And this is the tip of the iceberg. It's not the full iceberg. It's the tip of the iceberg.
If you don't mind stopping sharing, so people can see us both.
Of course.
Sadly for me, we ended this hour we had for this conversation, and I'm assuming we have to have a conversation to do episode 2 one of these days. we have to negotiate that. But thank you so much. I would summarize everything I have heard in 2 sentences, as you said. Don't do it unless you need to do it, and but when it's the right time to do it, and when I actually need to do it, when it makes sense for you to do it, I hope this last hour tips can help you a lot by focusing on the things to take care and to address, and some very useful tips, some very I would say valuable knowledge shared that hopefully will allow members of Canopy community to keep facing this incredible adventure, which is trying to change the world by everyone's ideas and projects and everything, with the support of the investors, because investors are a critical part of everything, and they support us. They're not the enemy. They're not the menace. They're not the necessary mean. No, they are the supporters. They are the guys that are actually backing us and our ideas and our path. And having here the opportunity to thank a supporter through thank you to this wonderful guest we had today, Filipe. If you want to end this with a final sentence, a final tip, a final suggestion to our beloved community.
No, it's just thank you for the opportunity. Again, it's always a pleasure to talk about this. If I can help in anything else, just reach out. And just to reinforce your idea also, Pedro, I think that is really important. Investors, they are not the enemy. They are definitely someone to help, and it's true that there are a lot of business that were successful without external investors, but there are much more that are successful with investors. But the thing is, they have their own business, the investors, so the founders need to respect that also. So it is something of a mutual respect. Investors need to respect the founder's business. Founders need to respect the investor's business. And that's basically what I try to say is talk to the investors you think it makes sense for you, for your business, and respect each other. And of course, you will make great things, the better things in the world. The best innovations are coming from this new company. So go out there and change the world for the better.
With these inspiring words, we end today's episode of How To's from Canopy Community. We hope to see you on the next episode. Thank you once again, Filipe. And
thank you.
Hope you enjoy. Take care.
Bye. Stay safe.